Of the webinar series tonight. Thanks very much for attending. And if you have not listened to part 1 and 2, please don't worry about that. That is not critical. That's not going to impact your ability to enjoy tonight's webinar. We have a very special guest, Ches Hagen from AP Capital with us tonight. Ches, how are you doing?
I'm doing great, Peter. Thank you very much for having us.
Fantastic. Well, listen, I'm just going to, before we jump into what AP Capital is and what you guys do, Ches, the one thing I wanted to just take a step back, and for the benefit of our audience here, I want to talk about, go over a couple things. Again, if you haven't already been on some of the previous calls, one of the things we talk about is the importance of putting together a financial plan. And in that financial plan, it's all about having a strategy. If anybody's ever worked with me on the mortgage side, as you know, 20 years working as a mortgage broker, it was always about a strategy, starting with the end in mind. Moving forward, as we continue to look at mortgages and building your financial future and looking at real estate from an investment perspective, a lot of my clients often would ask me, Peter, I know I've got a portfolio of mortgages and a portfolio of real estate, but what about my RSPs? What about my TFSAs? What about my registered products that I can't necessarily use in real estate? What are my options in there if I can't use them for direct real estate? Well, that's where I started looking at the exempt market market and looking at different options and asking clients the same questions I asked if you're buying real estate. Where are you now? Where are you going? What's your plan to get there? And on that point, if you don't already have it, one page I recommend you grab if you have it. If you don't, send me an email and ask for this. It's my personal financial landscape. The whole concept of this is to analyze where you are today, taking a look at your lifestyle, your budget, your income sources, savings, investments, and real estate, but also looking at your non-real estate. It's basically taking stock of where things are at today. And then on the right-hand side of the page, analyzing where you see yourself in the future. Pick a date, whether that's 5 years, 10 years, 15 years, 20 years down the road. Pick a date and say, okay, well, that's where I see myself down the road. What do I want my lifestyle to be? What do I want that budget to be? What are some of my income sources? And then when you look at that and say, well, here's where I'm going to be if I'm retired, I'll have a pension. And then you analyze, well, my budget is what I would want it to be in the future. My projected income sources might fall short, so therefore I have to look at my real estate today, my non-real estate assets, my RSPs, my TFSAs, and it begs the question, if there's a gap between where you want to be and what you're projected to earn, you have to take that gap, reverse engineer it, come back to where you are today and ask yourself, how do my investments have to perform? What result do I need from my investments today in order to accomplish the end result? And that's the key that I want to focus in on, because at the end of the day, it's a holistic financial planning approach. That's what we do at TriView Capital. I'm the Vice President of TriView Capital in addition to my role as a mortgage broker, and that requires us to look at an analysis from a holistic perspective of both integrating real estate as a mortgage broker, private equity, and the markets. And on that note, we have a lot of different opportunities that we see all the time. One of those opportunities is with AP Capital, Alta Pacific Capital, and what Alta Pacific does is invest in mortgages. So with me tonight is one of the partners at AP Capital, APMIC. MIC stands for Mortgage Investment Corporation. Ches Hagen. Ches, how are you doing tonight?
I'm doing great, Peter. Appreciate the opportunity to spend some time with you this evening and kind of go over what we do here at AP Capital, and also just chat about the general industry and the space that we're in, and this very furious mortgage space and the real estate market as a whole here in Canada. Thanks for having me.
My pleasure. Well, there you go. I got your lovely mugshot shot up on the screen now. So I just had to shift between PowerPoints. So you know what? We're not going to do this as the typical. Okay, I'm going to let you do half-hour sales pitch to the audience, so to speak. So Ches, really just want to have that fireside chat, if you will, where we can learn more about you. And I encourage anybody who is listening on this to send me an email. Michael, I just got your email. We'll address your questions. But first of all, before we get into the weeds, so to speak, just tell me a little bit about your background. I know you started in the, your background came from not a banking background, but more of a IT background, correct?
Yeah, that's correct. So I was actually born and raised out in the Fraser Valley, Peter. I was born in Abbotsford, raised in Abbotsford, and then attended BCIT in Burnaby. And upon completing that BCIT in 1999, 98, 99, I went to work in the software industry. Of course, you remember back then, that was the tech bubble, right?
Yeah.
I was I'll say in my mid-20s at that time. If you weren't working in the technology business or in the software.com world, you were probably going to be unemployed, is how you felt anyways, as a mid-20-year-old. So I went to work in the software space and started with a startup. That company grew. It actually became quite notorious in the country, won some awards. That sort of ultimately led to what I'm now doing, and that's kind of a funny story how those things connect. But in my
yeah, well, I remember
20s,
you telling that story, so I'd love for you to share that.
Yeah, so in those days, of course, I didn't know much about saving for the future or any type of tax planning, except that I knew that my accountant told me I should maximize my RSP contribution. So I did that every year, kind of in my late 20s, early 30s, and had built up a pretty decent RSP amount of funds. I initially tried to self-direct them. So in those early days, I opened a TD Waterhouse account. And I started to buy Nortel when somebody told me to, and I probably should have shorted it. And Peter, you kind of know how it went from there.
So much for a passive investment.
Yeah, well, it was stressful more than anything. Kind of watching the daily ticker, and anyone who's investing in the public market today is probably experiencing that anxiety and that tumultuous day-to-day public market world an awful lot. So, in those.
Well, I'm going to throw up a slide. I'm going to throw up a slide here because just on that note, look, here's one I just found from The Guardian. Look at this. I don't know if you can see that. Panic situation, Asian stock market tumbles amid fears of new global recession. So that just is like almost bang on with what you're talking about there.
Yeah, you see if you jump back to it, you see the guy's got his hand on his forehead, and that's how I looked almost every other day. What am I doing? I've saved hard. I don't want to lose this money. So anyways, the long and the short of it is that I went from self-directed RSPs to actually handing them over to a investment fund dealer. And I remember it was a neighbor to my parents out in Abbotsford, very successful guy. And I said, hey, I just want you to, obviously grow my money, but certainly I don't want to lose it. And I'm young enough that I don't mind taking a few risks, but I'm also I don't want to lose it, right? That was always the feeling that I had.
I kind of want return of my money, not just return on it.
Exactly. So I did that for, I'm going to say probably 3 or 4 years, and I'd get the quarterly statements of my mutual funds, and sometimes up, sometimes down, sometimes flat, and I almost became conditioned to the reaction of just don't be down. And I almost wanted to see flat or up, and so many times I'd see my portfolio value drop, and that was painful because I knew how hard it was to make that initial money and save it, and then to see it kind of go backwards was really tough for me. And in those days, of course, I was single at that time. I'm married with kids now, but back then, of course, when you don't have those family obligations, you can save even more money. So I bought some real estate with my now business partner and longtime friend. And the long and the short of it is I remember making money on real estate. And I know a lot of your connections and network obviously believe deeply in the real estate side. I certainly do. And so I saw this, on one hand, I'm making money buying real estate, and then on the other hand, I'm sometimes losing in my mutual funds. So the day came where I said to my partner, Brad, how do I get these RSPs out of mutual funds and into real estate? And the answer was, we're starting a MIC. So this is like,
you go, what? What's a MIC?
Exactly. That was my first response. What's a MIC? So that was late 2006. Early 2007, and so my business partners, all very experienced in the real estate space, in the mortgage space, in the lending space. I'm probably the more detailed guy when it comes to, I come from that software background, and so
you need someone that knows how to dot the I's and cross the T's.
Yeah, so I guess that's where I come up with the pencil and do the dotting and the crossing.
Fantastic. So you looked at this and you left investing in the markets and you went into investing in mortgages. Originally, did you guys just use your own money?
Yeah, for sure. So, when we formed the company, we incorporated in 2007. There's quite a few steps in forming a mortgage investment corporation. This is an entity that was created by the federal government back in the late 70s. And because we issue securities, we are, regulated by the securities commissions in all the jurisdictions or provinces that we operate. So it just took a while for us to kind of get all of ourselves in order. So we raised the first money in the kind of 2008, and the first money came from us as founders and our families. And so the first 20 or 30 investors were, in fact, close friends and family, all of which are still investors today. And so that first, we'll call it 3 to 5 million. I won't say it came easy, because convincing even your own mother
that
they should,
trust me, sometimes that can be the hardest one.
That's right. So yeah, a lot of it was the first friends and family, and then after that sort of first 20 or 30 investors, we started to reach out to a larger audience, and we've grown, since then over the last 8 years pretty consistently.
Now, I want to pause there because a lot of people know that I formerly, with a partner, had a APMIC, again, Mortgage Investment Corporation. There's probably a lot of questions people have out there on the line tonight. And for the benefit of those listening, I just want to take a step back and explain a few how everybody fits into the picture, because I mentioned my company, TriView Capital. I'm a mortgage broker with Dominion Lending. Now we got AP Capital. It can get very confusing with all these different terms. So I want to just kind of take a step back. Ches mentioned that when you start forming a MIC, a Mortgage Investment Corporation, for the purpose of lending out money in private loans and then earning the interest income as part of what the investors get back. We'll circle back to how that works. Again, for the benefit of the listeners, the market, actually, the Securities Commission says when you get started, correct me if I'm wrong, Ches, but you can only go to family and friends or accredited investors, people who qualify at a certain level, because you can't just randomly go out there and start collecting TFSA money or RSP money from, Bob and Mary on the street, correct?
Correct.
Now, so one of the things that's really important to understand is because a lot of people are not familiar with the exempt market, AP Capital, APMIC will fall into what's called the exempt market because it's exempt from a prospectus, which means your shares are not traded. When someone invests with you, they're not investing into something that can be traded on an exchange, and therefore it's not liquid, which is an important topic we'll get back to. So what the Securities Commission did, they decided to create something called the exempt market. And the exempt market needed gatekeepers, if you will, people who will protect the general public from, some of the private entities that may not be, how should we say, as scrupulous as others. So these exempt market dealers, one of which is TriView Capital. So I'm a vice president with TriView Capital. Our role is to be a gatekeeper. So we analyze different products out there, different companies in the private equity world, one of which would be the mix. So we would analyze and interview and talk to, it's kind of like the Dragon's Den, companies come to us, they pitch to us their ideas, and we look at them, we do the due diligence behind the scenes, and then we say, okay, we like these guys. And when it comes to mix, I want to tell you, Ches, we love you guys. You guys are fantastic. Not just because you do a good job, but there's a lot of integrity in the background, and there's a lot of due diligence that went behind the scenes, understanding how the mortgages are underwritten. It's a good team there. So I just wanted to explain the role, the connection between TriView Capital, who I am, what our role is, and AP Capital, what Ches does. So we are actually a dealer, and AP Capital is one of the products on our shelf. So hopefully that makes sense. Having said that, okay, there's a kind of a quick preamble as to the relationship here, and I do see a couple of questions from Michael and Brian. Before we jump into those, Ches, let's just break this down, because one of the first questions, again, if we're looking at investing in mortgages, I've got a mortgage and I'm paying 2.2%. So why would I want to invest in mortgages and get 2.2%. How could that possibly be a good return on my money? And if my mortgage is only 2% or whatever, 3%, how are you guys getting 7, 8, or 9% returns?
Yeah, that's a real common question, Peter. I would if I could ask you to just jump forward to slide 8. The reason why I like this one is it kind of speaks to the world of interest rates in this country. On the very far left-hand side, of course, everyone in the sort of lending space is very familiar with the Bank of Canada overnight rate. 8 times a year, Bank of Canada comes out with an announcement, tells the world what the overnight rate is going to be. There's always the rumors leading into it. You know, is it going to drop a quarter point? Is it going to go up a quarter point? Because ultimately, that overnight rate is what influences prime.
Right.
On the very far right-hand side, right, is the payday loans people. They're generally in the neighborhood where somebody just can't quite wait for that paycheck to come. People are paying the exorbitant interest on that far right-hand side. But this world of typical interest rates, we'll call it, it really resides on the left-hand side here. You know, people in the mortgage space, generally their minds think about the conventional mortgage business. That's, you know, the conventional lenders, the big guys, the BMOs,
chartered banks,
the chartered banks, right? And then, of course, people are also aware of credit cards. If you don't make your monthly payment, you're going to be paying, unless it's a low interest rate card or an, you know, sort of one of those early 6-month low fee cards. Typically, if you don't pay your Visa or MasterCard on time, they're going to ding for a pretty hefty 22% or more. There is this whole non-conventional mortgage space and lending space in between that sort of conventional and credit card. And it's a very busy space. There's lots of parties that participate here. On the lower single-digit side, you have the trust companies, the People's Trust and the Home Trust. And then on the sort of up as you near the double-digit side, you get into all types of firms like us that are lending in the high singles and the low double-digit rates. We tend to lend in short-term cases, so these are not 25-year term mortgages or 30-year term mortgages. They're short-term. In our case, 1-year term mortgages. And so it leads to a bunch of questions, but it does speak to an entire lending world that isn't your conventional mortgage from CIBC or BMO or TD.
Yeah, and you know, and that's a really important distinction there, but it still begs the question. I mean, I got to think there's a lot of people listening to this that are going, oh my God, I'd never get a mortgage at 10, 11, 12%, or I would never get a mortgage. You know, I've always been able to qualify at the bank, so I can't even imagine who would, you know, other people on the line are going, oh yeah, well, I can imagine. I've done that, been there. So why don't you maybe address some of the reasons why people are in a position, why they would be willingly, you know, why it makes sense for them to borrow money, and also clarify, we're talking first mortgages between, what's the range of interest rates on first mortgages versus second mortgages?
Sure. So first of all, that first question is like, who would be a borrower in this case that would pay these kind of rates higher than your conventional side? You know, there's a couple buckets they fall into, but a big bucket are in fact those people that are business for self. If you're a business for self or self-employed, or you file, you know, a tax return for your company, plus you have personal income and you maybe do some income splitting with your spouse, which is real common in Canada. These people, and I'm sure there's some on the telephone call tonight, are finding it more challenging to work with a conventional bank here in 2015-16 than they did back in 2009, 2010. And
yeah,
so,
that's probably going to, that trend's going to continue.
Of course. And so they're sometimes in a situation where they might have an awful lot of equity in their home. They might be very good credit-worthy clients. They might be very high net worth people, and yet the bank says no. And it seems strange, but it's happening every single day. And I know from if you wear your mortgage broker hat, Peter, you're seeing this an awful lot as a broker. People
Absolutely.
that you probably could get approved at a conventional bank just 5 years ago, you're having to look for a more creative way to help them put together their deal.
Yeah, absolutely, and that's with homeowners, not to mention investors, for example. You know, you and I actually had a conversation earlier today. Just to give you an example, there was an individual they were making a purchase on a home, and the down payment's going to come from the sale of their existing home, but it's not sold yet. So they needed to come up with the deposit money. They needed $50,000 on the deposit, and you know, it could be cumbersome going to the bank, and they may or may not react quickly. So, Jess, you and I talked about, well, we could use APMIC that can lend them the down payment, or sorry, the deposit, and the security for you guys is that when the sale completes, they sell their original townhouse in this case, and that pays you back. So one of the other things that's really important to clarify here, we're not talking 25-year mortgages.
Yeah, no, 100%. That's a great example you give. Another one that we see, and it's not that uncommon, is that people that are locked in, or pardon me, they're in a fixed mortgage, and they're maybe 3 or 3.5 years into that fixed mortgage, and for some reason they might want to break that fixed mortgage. There was an example just literally 2 weeks ago of a very, very top quality borrower that wanted to help their son purchase a home, and he wanted to use the equity in his home to help his son with a down payment. But if he breaks that, if he's 3 years into a 5-year fixed, you know what the interest penalty is going to be on that.
Yeah, yeah.
So instead, he looks at us and he says, okay, so I'll borrow this money. I'll put a second mortgage on my home. I'll borrow it at 9%. I'm a 1.5 years away from being able to resolve this. I'll pay the higher interest rate because it pales in comparison to the interest penalty to break my, you know, I'm 3.5 years into a 5-year fixed. So there's just so many different scenarios. You know, another one again comes to mind is, it's unfortunate, but half of people that are married get divorced, and oftentimes their biggest asset that they have to disperse is their home and the equity of their home. And what happens when people get divorced? It just so often they're just abusive with their credit. You know, the husband or wife doesn't make the minimum payments on the credit cards a couple months in a row, and next thing you know, they go from having a 700 beacon credit score down to 580, and it doesn't take very long, right? And so when they go in to talk to the bank after they've kind of, the emotions have settled, and now they're ready to, you know, split the one asset that has some value, the bank says, hey, you got to clean up your credit. We can't, you know, we could have talked before, but we can't today. And so that's where we're just sort of a short-term solution to, you know, various different scenarios. And the notion that, you know, the borrower, I was just going to say, you know, my final point, Peter, is that I think there's a common notion that, oh, well, you only lend to people that are, you know, poor credit, you know, poor borrowers. You know, I sometimes say you throw a cinder block at people that are treading water. It's just not the case. We're not in the business to loan to own. We don't want to loan and then ultimately take somebody's home away. So most of the time, it's putting them in a much better situation. Wow. And yes, they're paying some higher rates to us, but it translates into a better, you know, world for them at the end of it all. So.
I'm so glad you shared that. That's fantastic, because there is a prevailing misconception out there, and I was doing the mortgage minute the other day. I said that the investing in mix is probably one of the most underutilized and misunderstood vehicles out there. Personally, I'm a little biased, but I believe it's one of the best investment vehicles. But there are people who are saying, well, you know, hey, I know I can get 7, 8, 9% return, but, you know, I don't feel good about that. I don't want to earn money off of other people's hardships. I want to, you know, a more an investment I can feel good about. And there's that kind of, you know, I want to use the word Shylock image from Shakespeare, you know, the money lender. You know, it's like, I think it's important to shed light that what you guys do really helps a lot of people.
No, totally. I mean, it's just case after case after case, helping the dentist use the equity in his home, or use the equity in a paid-off rental property to buy out his dentist partner that's getting to the age that he, you know, wants to sell his portion of the dental firm. I mean, the examples just go on and on. This is really, you know, while people do think back to that conventional mortgage rate, and again, it's still in your slide, 2.5% to 3.5%. Yeah. That's really, I mean, we use the term mortgage, but really we're advancing loans to people. We're using mortgages as the security, right? But ultimately, we're lending 1-year term. It's higher rates, yes, but what it's doing is it's allowing people to execute on expanding their business, paying out their business partner, helping their child buy a home.
Facilitate a means to an ends to a mean.
Yeah, totally.
Again, I use my own myself. As some of you know, I bought a commercial building here that I recently sold. I bought it back in 2008. If I did not have access to private money like this, I would never have been able to close on that. And let's just say I did okay. I made a very healthy profit on the sale, but that would never have happened if I did not have access to companies like APMIC. So, okay, I don't want to beat a dead horse. I think we've established the fact that you guys do not, you're not out there doing these ridiculously risky loans to people who you're not greasing the skids on helping people go into bankruptcy. You're not part of the greater problem out there. You're actually a facilitator of solutions and helping people get from point A to B. And yeah, there's a reason those people can't qualify at the bank, and therefore they have to pay a higher interest rate, but it's a short-term solution, and it typically facilitates the ability for them to get themselves in a better position at the end of the day.
Yeah, no question. I mean, if you just go back one slide, it speaks to some data on the use of people's homes.
Is that the right one?
Let's see if yeah, here. So there's about 10 million homeowners in Canada. So roughly 1 million homeowners took equity out of their home. This is 2013 data from CAMP, Canadian Association of Accredited.
Sorry, do I have the right slide up there? 11% of homeowners?
Yeah. So it's 11% of 10 million. So it's about 1 million homeowners in Canada took equity out of their home. Like I said, this is from 2013. And you can see how they use those funds. You know, some people certainly use it for debt consolidation. Some people renovate their home. Sometimes they purchase, another home, education for their kids, a boat, whatever. Some people use the equity to buy investments. And then there's other purposes. So this is not, I mean, this space that we're in, right? And this, I mean, some of these people are using a line of credit at the bank at Prime Plus, some. Others are coming to people like us. So it's a very, very active market. I know that, like here in British Columbia, Peter, there are, you know, arguably, I'll say between 50 and 100 mix. There's probably 25 of, you know, that are a going concern, we'll say.
Yeah, and that goes back to what we do at TriView is we analyze which ones that we've done the homework on that we would even entertain making available to our database, because ultimately, you know, we're responsible directly to the Securities Commission as much as you guys are. So, you know, we've done the homework on that. So again, let's just say, okay, we get the idea. This is a good vehicle. It's helping people. There's a need for it in the marketplace. Okay, that's really all I'm trying to establish there. And yes, people pay higher interest rates. So there's a need for it out there. You've heard the advertisements on the radio. If you own your home, you can get that loan. So you know that I was talking to one person that they said they get $4 of revenue for every dollar they invest, and I found out afterwards they were spending $1 million a year on radio and television advertising, and this was another private entity, which told me that they had revenues up upwards north of $4 million. So suffice to say, the marketplace is there. Whether you could envision borrowing money like this rate or not, the truth is there's a need for it, the marketplace is there, and it's a great business model. Now, how can you participate as an investor? I've got a couple of questions here, and I just want to let Michael, Brian, Rizwan, you guys, I will get to your questions shortly here, but before I do, Ches, I'd like you to walk me through the actual process, just like really, you know, dummy this down for me and help me understand. If I'm considering investing in, I got money, I got space in my TFSA, for example, or my RSP, I'm looking to invest before the deadline. What would an investment like with your company look like? Can you walk me through how that works on your end and how the money is dispersed, et cetera?
Yeah, so first of all, you'd call Peter Kinch. No,
good answer.
Yeah, you know, it's pretty straightforward. We are because we're a mortgage investment corporation, that corporation issues shares. So every shareholder or every interested investor becomes a shareholder. And today we have just shy of 1,000 shareholder accounts in AP Capital MIC, roughly $40 million in investor capital. In addition to that, we have a line of credit with our bank, HSBC, for another $10 million. So we're a lender in the space for about $50 million. But as an investor, I become one of those 950 shareholders. So it's a pool, it's an investment pool. And the day you become a shareholder, you also become a shareholder of our current mortgage portfolio. So today we have just north of 250 mortgages on residential homes in the Canadian market. Now we focus primarily on single detached residential homes in urban areas. And we really like the Vancouver, all the way out to the valley. That's our market. That's really our focus is the single detached home from, Greater Vancouver, Lower Mainland, Fraser Valley. So as an investor, you become a shareholder. You own the only class of shares that receive our distributions, and I'll get to that in just a moment. But you're a part of a pool. And so when we actually become active lenders in the space, like we are every day, advancing mortgages, being paid out on mortgages, we are listed on title, no different than BMO's listed on title. So if we pull title on one of our 250 mortgages that we have advanced, you'll see AP Capital listed on the title document, and in the same way as you would if we were TD on title. And so the shareholders become shareholders of AP Capital MIC.
Mm-hmm.
And then we do, of course, as a MIC, according to the Canadian Tax Act, and this is where CRA gets involved and our auditors, we must distribute 100% of our net income at the end of our fiscal year. So we perform our audit, we use MNP as our auditors, and at the end of the fiscal year, the auditors determine our audited yield, and that becomes the official audited distribution to the shareholders. Now, we do have a monthly distribution that we target and have achieved since the beginning, and that's 7% per annum paid monthly. So when the audit completes and we perform better than 7, then there's we sometimes call it the 13th distribution to kind of make up the remaining balance of what's owed to the shareholders. So that's kind of the nuts and bolts, and I think probably the high-level description. That probably leads to several questions, but
I'm sure it does. Do you have a slide that you want to reference on that?
I think probably slide 18. I mean, it just kind of speaks to the fact that all returns are return on capital, so it's not return of capital. When we are making that 7% per annum monthly distribution, we're not returning people's initial investment. We are returning the return on capital. So that's why there's all caps and a bold statement.
Right, yeah, no kidding.
Sometimes in the world of real estate, returns that are paid out monthly or quarterly or annually are a return of capital. There's definitely some tax advantages of that, but it starts to, kind of play into, well, how much of my capital is left. Of course, we take RSPs, TFSAs, we talked about that, as well as open investments, so somebody has just funds in their checking account.
So, Ches, I want to just address one thing that can be a common question. Somebody might say to me, "Well, you know what? I'd like to lend my money directly, so I can be hands-on, and I get 12%." Now, I always see that as much higher risk. Would you like to address that from a risk perspective?
Yeah, I mean, there are certainly people that do that well. And I would always encourage those people to continue to do it. I mean, if you can find good deals and you can get those types of returns, it would behoove you not to continue to.
I might jump in there. Sorry, just say it depends on if you're qualified to understand or know what a good deal is.
Of course, right? So, I mean, there's just probably the graveyard full of people that thought it was simple and then found that that one deal, they maybe did one or two that worked out, and then the third one ended up biting them. So, when you invest with somebody like us, like I said, the day you become an investor or a shareholder, you are instantly a part of 250 mortgages. So if 3 or 4 go south on us, it's not going to be an issue that's going to affect your capital and very likely not going to affect your return. And so, we have a team of underwriters that is looking at deals every day. We source these deals through mortgage brokers. That's really our primary sourcing mechanism, is through the broker community. And so, if somebody's out there doing it themselves, it goes from being, kind of a quote passive investment to a very active one. So if you've lent your own money, You know how quickly you're having to get involved when that monthly payment doesn't go through, or that monthly payment bounces, or you're 90, 60, 30 days from maturity, and you're calling the borrower and saying, okay, you're coming up and you're due, at the end of August. That's what we do every day, right? We're sending the letter at 90, 60, 30, and if that person goes into arrears, we're dialing them for dollars the next day, and if they continue to go into arrears, we foreclose. I mean, that's what we do every day. And so it's the difference, and we take a 3% management fee for doing all that activity on hundreds of mortgages every year. And so it's the difference between doing it yourself, which is no small effort to source them, no small effort to manage them, versus having somebody else take care of it for you.
Okay, so you mentioned you get a 3% management fee. That's a big question for a lot of people. So if I look at this and your target return is 7%, some people might think, well, if you're taking 3% for management, I'm only getting 4% of that return.
Yeah, so that 7% is net of fees. So we wake up in the morning and walk in the doors, and we have to achieve better than 10.
Right. Okay, so what you're doing here, for the average investor, they say, hey, I could do this on my own. I'm going to go find my Aunt Susie who wants a private mortgage, and I'll lend a mortgage to them. I can get 12%, and your aunt probably wouldn't be happy with you. But, I think two key things that, in summarizing what Ches said, number one, are you in a position where you can really, do you have the skill set or the ability or the experience and background to do a full analysis as to whether the person you're lending to has the ability to pay you back? And if they don't pay you back, do you have the time and energy and effort to pursue the legal avenues to recuperate your money? There's a couple of concerns there. Whereas if, well, that's what APMIC does for a living. And one other point on that, Ches, you've got, correct me if I'm wrong, I want to go through the numbers again because I think this is really important. 250 mortgages. You take roughly $40-odd million, spread that out amongst 250 mortgages, and let me know if you have a slide on this. But if my memory serves me correctly, you know out of the gate that you're going to have roughly about a 2% default rate on that portfolio of 250 mortgages. Is that correct?
Yeah. So if you switch to slide 13, it'll speak to the portfolio at the end of December. So this has been updated on our website for January 31st, so 15 days ago, 16 days ago. So feel free to check us out at apcapital.ca. You can go on there, see fun facts, which we publish every month on the current status of the portfolio. So I'll get to your default number in a moment, but we currently have just north of 250. We're almost entirely residential. The other remnant, which we call commercial, is really light commercial. It's not, substantial, large commercial mortgages. Our average mortgage size, $170,000, and the most important number is this 66% loan to value. We've targeted since the beginning to maintain an overall portfolio loan to value of under 70. And so what that means is that, yeah, well, it's important more than impressive, I would say, because the 34% that makes up the balance there is the equity in these homes that protects our capital, more importantly, investor capital. Our capital is the investor's capital. And so that's really the important piece, is that loan to value. If you go into our, if you go on our website, and I'm kind of on there on my other screen here, but we do, and I think it's on one of the next slides, if you switch over 2 slides, we talk about our, maybe just jump to 16, the next one, yes. This will speak to, the fact that we're heavily focused in British Columbia, you're on the right slide there, Peter. So 85% of our funds are in BC. We do some activity in Alberta. Those are in the major markets of Edmonton and Calgary. We've definitely, the piece of that pie has gotten smaller, especially in the last 18 months. Right. Low oil, NDP government. We're very much pulling back from the Alberta market. Our portfolio there is still in good health. And then that one on the right speaks to whether we're in first position or second position. We do more first and seconds, and a lot of mix actually, they're just
focusing on seconds.
Who might look different, yeah. So that's a bit more of us, and again, these are December 31st data points. If you, again, on our site, I'm just looking at them right now. not a lot of change. 54% first position, 45% second position right now in our mortgage portfolio, 93% residential. So a lot of it hasn't changed, December 31st to January 31st. But we publish that every month, and it's visible to all of our shareholders.
I can't emphasize enough why this is important because, and Michael, you've been waiting very patiently. You had a question right out of the gate here because there is a darker side to MICs and mortgages and mortgage investment funds. I know anybody who has had experience in Alberta, for sure, has experienced. There's been some real horror stories of people losing money in mortgage funds in the province of Alberta. And I think, and again, correct me if I'm wrong, Ches, but my understanding is a lot of those funds were heavily invested in development or commercial, and could be overweighted on one particular development, so that if that development goes south, suddenly you're really scrambling.
That's very true. And earlier on, I wanted to make a comment. You talked about the person that maybe lends to Aunt Mary or whoever the aunt was. Think about the recourse you might have on your aunt if you were lending her money, right? It's tough, right? She doesn't make the payments on time, and at the end of the term, she doesn't pay you. You got to go see her at family dinner while you're foreclosing on her. The reason why I bring that up is that many MICs, and I don't mean to say in Alberta, but the MIC structure can be abused and can be used to lend to non-arm's length entities. And so often it has been
the inner circle.
Way.
Yeah.
And so it's like, oh, we're raising capital for this project, and it happens to be my sister company who's actually developing this land, and we need to get zoning from the city, and then we're going to put in these building lots, and so on and so forth. And the MIC is actually being used as a financial structure to actually raise capital for a, quote, project. Well, if the market softens or has a blip at all, we all know what happens. It's the development deals that, are kind of the first to take the hit. And if you're lending to a sister company, it's like having recourse against Aunt Mary. It just is incredibly difficult to have. So we have just taken a very different approach to this and said we are going to act like a bank, and we're going to arm's length borrowers, people we don't know. Because if they don't pay us on time, or if at the end of term they don't pay us back, we are going to be aggressive in collecting, because my mom's RSP is on the line, and my RSP and 900 plus other people.
So rather than lending your money to family and friends, you got family and friends who are personally vested in the success and performance of the fund.
Right, and again, 250 is a decent number of diversity. There's a term that's used during the audit process, and I would encourage anyone, if they're looking at a MIC, to jump to the notes section of the audited statements of a lender and look for the terms concentration risk.
Yeah.
Because if they have too many funds in too few mortgages, the concentration of that risk lies in just a few deals or in a handful of deals. And if they go south, they can take the fund in the wrong direction. And if I look, and so we're very active on the BC MIC Managers Association. I talk to lots of other MICs. It's alluring to get into these development deals because they're lucrative, right? You can make good money, but they are generally the recipe for your sort of challenges. They will not always lose you money, but when they do, they'll hurt you bad. And whether it's in BC, Alberta, or across the country, they're the ones to avoid. And that's why we've really built ourselves around single detached homes, not construction, no, real specialty stuff. We don't do the big $8 million house in West Van. We don't do the acreages in Merritt. We don't lend against golf courses in Trail, BC, right? We're not
average house, average street, right?
Yeah, exactly. Because if something goes south, we go in there, we can sell it fast, we'll get our money out.
Exactly. And it's a lot. That's one of the processes that people don't understand. If you sit on the lender side, you actually have to assume, and again, correct me if I'm wrong, you have to assume that every loan you give to someone is going to go into default. And if so, would you want to repossess that or foreclose on that property? And if so, what's your exit strategy? Could you sell that in a downturn market? And if it's an extraordinary property, unique, like if there's a neighborhood and the average house price is $800,000 in that neighborhood, but one guy is building a $5 million colossal mansion, you probably wouldn't lend on that house, correct?
No question. I mean, this space just like we do, Peter, and that's just what we avoid, right, is that unique stuff. Because even if you look at Alberta right now, the general, and I'm sure you got some callers on the line, and maybe there's been some questions on this, but the typical sort of family home, let's call it the $400,000 to $500,000 home, or maybe even $550,000 in Calgary or Edmonton, just the regular family home, it still has a market. It's the stuff that's 700,000, 800,000 and above that's really feeling the effects of the downturn in the Alberta market, and especially in Calgary. We're actually seeing that the sort of standard residential home in Edmonton is still a pretty good deal. And so we're still doing Alberta mortgages, but we're doing the ones that we see in that family residential neighborhood, right? Not the premium stuff, and especially in Alberta. I can't emphasize that enough.
Well, and this goes back to what I said earlier. Our job at TriView Capital is to vet companies like APMIC before we ever allow them access to our database. So we've done our homework, and that's one of the reasons. What we're talking about right here is probably the primary reason, and I sit on that board helping to make those decisions, and that was the one thing that jumped off the page to me and why I love this as an investment. So I am going to get to Michael's original question here because he's been patiently waiting on it. He started out saying, obviously he had a negative experience, and I'm the first to openly share both the dark side and the light side. And it's not all sunshine and roses, right? But here's a case where he said, I invested in Care Canada Senior MIC 5 years ago. It had a healthy spread across Canada, earning approximately 7% a year for 4 years. Then trouble, the fund is earning 0.02%, and everyone is now doing retraction, which is restricted to 1.5% monthly, a very slow withdrawal. Any comments about the darker side of MIC investment? By the way, Olympia Trust also acts as the approved trust company for that MIC as well.
Yeah, so Peter, I can't speak to a specific MIC other than ourselves, but I can, and I think I said it earlier, and I'll reiterate it, because I do know some troubled MICs, and I speak to them because we meet quarterly as a group. And the troubled MICs are those ones that have concentration risk, and they're in those commercial or those development deals, generally land or development deals. And what happens then is that they can't get their money out. They don't want to take the bath by selling at a deep discount. And so they end up not having distributions, and they end up having a situation where they can't fulfill redemptions, or they do such a limited amount of redemptions. There's a lot of really good quality MICs that have a very, very large portfolio of residential homes in their portfolio, and they're generating anywhere, kind of similar to us, between 5 and 9%. And again, the higher end is probably when interest rates were a little bit higher. We're all facing a little bit tougher time hitting the 7, but run your business effectively, and we can continue to do so. So I don't know if I'm giving a good answer, but I think you really have to look at the composition of the entire MIC. You could have 255 mortgages, but if you had 4 of them that concentrated an awful lot of money on, say, a development deal in Agassiz or outside of Calgary in Canmore, and suddenly that $2-3 million loan wasn't being paid monthly by its borrower, and you don't want to step in and foreclose because you're afraid you're going to have to sell that for $1 million on the $3 million mortgage side, that $2 million hit is going to hurt you so hard. And so you really have to look at that concentration risk and look at, are there a handful of mortgages that are perhaps a bit of an anchor or holding any particular fund back. So, the dark side of this space is that I think I said it before, is that you kind of get, I think it was mentioned actually by the chairman of TriView, that you kind of have a strategy drift. You let yourself become allured into the deal that just, maybe pays a little bit better, but it can be the one that can kind of take you sideways. And so, we remain very disciplined. There was a time 2 years ago where we sat on an awful lot of cash because we didn't see the kinds of deals we liked, and we'd rather sit on cash in the account and see our return drop because of that than to just get it out for the sake of getting it out into deals and then deal with the consequence later, which can often lead to, what that gentleman is facing. So,
well, I can tell you,
clarity.
Yeah, I can tell you that is the single most important answer I got from Steve, the president of your company. And just put some background to it. I ran APMIC, and I had the choice. We were very small. I just had a couple of $1 million that I used to help with my own A side of my business, right? And I had a point where my partner and I sat down. We looked and said, well, let's raise $20 million, because if you're smaller than $20 million, the cost of operations just doesn't make it viable from a business perspective. But then I sat there and said, great, if I get $20 million of people's money that I've raised, I now have to lie awake at night getting that money out the door and making sure I'm making investments or getting mortgages out the door. And I'd go out to fellow mortgage brokers and say, do you know anybody who needs private money? Which really for me was not what I wanted to be doing. But the point was, I recognize at that moment that what happens is you get this chicken and egg issue, where if you raise the money, then you're constantly looking to get it out the door. And I call it the barking dog. The barking dog is the investor looking for the return. And if you get too focused on satisfying that 7% in a market where it shifts and changes, and you're sitting on a lot of capital, you might, and I emphasize you might go onto the skinny branches and make loans you otherwise, your gut tells you this probably isn't a good idea, but you take chances you shouldn't, and that's where some of the mix I've seen, unfortunately, fall apart because they weren't willing to give a lower return in lieu of security.
Yeah, no question.
I remember I asked that, so I said to Steve, I said, if the market changed and you thought it was not a good idea to continue lending and getting all your money out there, would you be willing to sit on cash? And his answer was emphatically, absolutely.
Yep, no question. We did it before. It's stressful to sit on cash. It kind of sounds crazy, but it's probably the most stressful, because you know that it's idle, it's not providing return, you're being inefficient. When we're the most efficient is when we have all of our capital out and we're into our line of credit a little bit. That's when we know that we're running, kind of at full efficiency, and that's where we sit today. But we're not naive enough. We're all in our 40s, and we got one partner that's in his 50s, but we spend a lot of time around other people in this space that we learn from them, and we learn that if you avoid the pitfalls that others have made, then that's going to help you make, survive and thrive. And if you just don't get too antsy when you're sitting on some excess cash, that speaks to something real important, and that is, I think, what sometimes people say, well, what makes you different from other mix? Well, I think I've spoke to some of it, but if you're in the residential space and you're using mortgage brokers as your main channel of deal flow, you talked about the people that run radio.
Sorry, I got to interrupt you there. Sorry, I hate to speak over you, but it's really important you emphasize you do not allow every mortgage broker to send you deals.
No, of course not.
You guys handpick the good ones.
Yeah, so we learned
That's
this.
important.
Again, we learned this early on. We don't use the shotgun approach. We use the rifle approach. We find kind of the quote best mortgage brokers that understand our business, understand this side of the business, the non-conventional lending. You call it private. There's different words for it, and we hone in on those individuals. And that's where I'd say where we have some I don't know, secret sauce, is that we really work hard to build those relationships with mortgage brokers. And the interesting thing is, Peter, often they become our investors because they see how we go about our business. And some of them are, in fact, our biggest investors. So, they almost have like a vested interest to bring us quality deals because it's ultimately going to turn around and be their funds and some of their family's funds that's going to go back out and lend on it.
Well, it reminds me of a story when I first got into the mortgage business 21 years ago, and it was with APMIC. That's how I got my start in the business. And I was a raw rookie, and 6 months into the deal, I hadn't earned any commission, so I was getting a little hungry and skinny, and I came across a deal that, I probably knew in my heart wasn't a good one. I brought it into the office, and I said to my mentor at the time, I said, well, here's when we should lend to this guy. And he took a look at it. He looked through the paperwork, and he said, fantastic, here's what we're going to do. Just as an aside, I had just come back from 5 years in Japan and had built up a large pool of capital, so my own money was invested in the MIC. So I showed him the guy that I wanted to lend money to, and he handed it back to me. He said, I'll tell you what we're going to do, Peter. Let's do the deal right away. We're going to lend him your money. And I just thought, whoa, what? No, shouldn't you? Maybe you should investigate this guy. Maybe you should do a little more homework. Are you sure this is a good investment? He goes, well, you thought it was 5 minutes ago. So lesson one for me.
I love that story, Peter, because we do that too. You'll get a broker, he brings you a deal, and we'll say, you know what, this looks good. So the guy needs 250. Okay, that sounds good. Okay, well, we got 200, so you throw in 50.
Yeah.
Sure that's no problem for you. Or even, you know what, just throw in 25. We'll put in the 225. And the guy starts backpedaling, well, I don't know. So it's a great way to just kind of test the broker on his deal, no question.
Absolutely. And, kind of wrapping up here, a couple things. First of all, there's no guarantees on anything. Markets can change. That's the nature. That's why it's called private equity. That's why the Securities Commission has you have to check a box that says this is a high-risk loan, mostly because it's illiquid. It's not something traded on the stock exchange, so if you change your mind the next day, you can't just get out. But when we look at foreclosures, I got the slide up there, 0.18% of the portfolio. If I'm not mistaken, is that your historical foreclosure rate, like in terms of loans that have gone into default?
No, it's not, Peter. That is so that's a snapshot in time on December 31st, along with the other stats in this deck. So it should be a disclaimer on there. When I present in front of an audience, I always speak to that. If you look again on our website, right now we have 5 foreclosures out of 250. It's 1.23% of our portfolio. The average, this is the most important statistic of those 5 mortgages. The average loan to value on them is 59%, just shy of 60%. So a foreclosure to some people, especially to an investor that doesn't maybe fully grasp this business, they feel like, oh, a foreclosure, you're going to lose all the money. It's just not the case. A foreclosure just simply means we're going to be delayed in getting paid out. If that, and I say if that loan to value on that deal, or that, in this case, 5 mortgages today, is in a situation where there's equity and sufficient equity, because as you know, when it goes through the foreclosure process, there's a demand letter, then it goes into the court's hands. They often give 3 to 6 months. Then there's a court-ordered sale. There's a bunch of steps in between here, but I'm just jumping to the high points. And by the time
bottom line is A, you guys know what you're doing. B, you're not losing the money. You're just delaying the return of it.
Yeah, exactly. And so our portfolio is sitting anywhere between 0.2 is extremely low, this 0.18, to kind of the 1.2, 1.5. And it fluctuates throughout the year. We should always have 5, 6, 7 foreclosures underway. That means we're running our business effectively. If we have
what about 2008, when the market went in the toilet, where we had the worst point in time, 2008, 9, and 10, when things were really bad? What was the foreclosure rate then?
Well, quite frankly, Peter, that's when we first started. So we don't have that data point to look to, but we learn an awful lot from talking to others. And so, when you look at, a lot of people speak of, an overheated real estate market, and actually, if you switch back, and I know we're running short on time, but when maybe you can switch quickly to slide 9. But when you look at the markets across the country, this is CMHC data from 2 weeks ago. And it just talks about whether specific cities in Canada are considered problematic. And, you look at Victoria, Vancouver, they're considering those weak, in the form of weak problematic conditions. They're seeing cities like Toronto, Calgary, Saskatoon as having strong problematic conditions. So, again, I want to reemphasize something on this front, because it's a common question. We are in these deals for 1 year. So when we're underwriting the deal, we look at this home and we say, okay, it's a home in Burnaby. It's being appraised. Independent appraisal is telling us that it's a $940,000 value. We ask ourselves as an underwriting team, is this going to be worth $940,000 today and in a year from now? Now, we don't have a crystal ball to know what it's going to be worth in a year from now, but most people would agree that interest rates are not going to come storming, they're not going to escalate quickly in the form of a year, right? The overnight rate is going to change slowly when it changes. And so we're going to see prime change along with that, and you're going to see conventional rates follow. And then you're going to see, that will have an effect on the real estate market. There's not going to be a wholesale departure of, British Columbians from the province or from Vancouver unless there's some reason to, but no one's really seen some dramatic change in population, right? So the
absolutely. Well, and everybody's worried about the proverbial bubble bursting, and I've always said there's two precursors to a bubble in order for it to burst, and that is a significant sharp rise in interest rates combined with a significant sharp rise in unemployment. And we're seeing pockets of Alberta experiencing significant sharp rises in unemployment, but what we're not seeing across the country is, and certainly not in the Vancouver market or go anywhere, is significant sharp rises in interest rates. In fact, they're probably looking at a prolonged period of downward trend there. Ches, we're really running up against the clock here, so I want to get to the questions that some of the people have had here, waiting patiently. A couple of quick and easy ones. Minimum and maximum that you would allow or available to invest.
Yeah, so our minimum investment is $10,000. On the maximum side, we cannot have a single investor with more than 25% of the shares held. So therefore, we couldn't have somebody with more than a $10 million investment. That's pretty high. Our
there you go. But if you got $9 million, just talk to me. We'll figure that out.
Yeah, exactly. So we have several seven-figure, million-plus dollar investors, and we got lots of people with a $10,000 TFSA, and then a whole bunch of investors kind of fall in between. So as the disclaimer on the first or second slide says, every investor is different. Talk to Peter. You need to understand your goals and so on. But those are hopefully answers to that question.
Is the initial investment locked in for a minimum time frame? Is the distribution considered a dividend? When can one pull out their initial investment?
Yeah, good questions. Okay, so there is not a lock-in period per se. There is a redemption fee in the first 4 years, and that redemption fee is 5% in the first year, 4% in the second year, 3%, 2%, and then 0. So people should be thinking about this being, medium-term investment. Like you wouldn't consider us an ATM deposit, make an investment and then pull the funds out.
Yeah, one of the questions was here 30 days. That would not be appropriate.
Would not be appropriate. No, I mean, I don't think they should think of it that way. But we do handle redemptions every month. So if somebody does have an unforeseen financial need and they're 2 years in and they are, they've perhaps, let's just say done well with the 7% or 8% that we've done in the historically, and I'll get to that part of the answer in a second, then they can take the 3% redemption fee in year 2 or 3, pardon me, and get their funds out in 15 days. Let us know by the 15th, and we'll pay you out on the 30th. Now, I put a little caveat to that because the larger an investor, the longer lead time we ask for them to give us. So if somebody's got $50,000 invested, we'll have it back to you by the first of the month, the following month. If somebody's got $1 million with us, we always have a chat with those people and say, if you need the funds back, we need as much time as you can because we're planning around commitments on mortgages, commitments on other redemptions, the monthly distributions, and so on. The last question you asked was about whether these are considered dividends. We actually are, because we distribute 100% of our net income, and because we're a mortgage investment corporation that's considered a financial institution, the CRA, this is interest income. So we distribute a T5 tax slip, and they just went out today, in fact, because they got to be out by the end of February. So it's a T5 tax slip considered interest income or investment income, pardon me. It's box 13 if you're a chartered accountant. It's
there you go.
Box 13, and so if it's in your registered funds, it's no consequence. If it's held, in open, then based on your tax bracket, you'll pay accordingly.
Yeah, and the last question is, the one line here is a 7% yield after the 3% fee from John? Yes, we did touch on that earlier. And just, I know you're not supposed to talk about historical. We targeted 7% with this, but what are some of the historical numbers you've had in the last few years after net?
I don't know if I'm not sure if it was my screen that went dark, but you had slide 11 up. It showed that we've trended over 8% since we launched in 2008. I said also a moment ago that, because interest rates are definitely lower today and they've been remaining low since 2010 when the overnight rate got down to 1 point and declined from there. We do face some headwinds in this world of lending. The only interest rate that isn't changing is people's credit cards, but your mortgage rate on your home is getting more affordable, and the deal we used to do for 11%, we're now doing for 9.85%. So we're on track to deliver better than 7 this fiscal year, but it's getting tougher and tougher to hit that target return of 7. So that's what we.
And you know what? Let's be honest. When we're looking at markets in general since January, everything that's publicly traded, anything that you got your RSPs in, if your RSPs are in mutual funds right now, they have taken a hit. I don't care who you are. The best investment advisors, portfolio managers in the marketplace are bragging about only losing 1 or 2% compared to the market losing 15 to 20. So we're talking, maybe moving from 8% down to 6%. I don't know about you, but if anybody's read my book, the last chapter in the book talked about exit strategies. One of the exit strategies was liquidating your real estate portfolio, moving it into some vehicle that can get you a 6% return. That's the quote. That's the number I quoted in my book. When I wrote that, I was thinking, Mick, I'm going to be honest, that's exactly what I was thinking. And if you had 6% on a $3 million portfolio, well, that's $180,000 a year of ongoing income. So, it's not a bad thing if you're apologizing for only being able to get 6 or 7% this year.
Yeah, not that I'm apologizing. I'm just kind of pointing out the condition that we're in. But
absolutely. Just one last thing on this. Why is this a good vehicle for a TFSA?
Well, I mean, all registered funds are really they defer the tax piece until you go and pull them out. Obviously, at TFSA, you don't experience the deference of the tax element, so they're great for a TFSA. You put them, you invest through your TFSA, you see it grow and grow and grow, and the day that you pull it out, you don't have a tax consequence. So
because it's taxed as income, correct?
Well,
it's taxed as income, correct?
It's not. There is no tax paid into the TFSA return, so the full return is recognized in the person's TFSA.
No, I mean if it's outside the TFSA, the distribution that you provide to the investor is taxed as income to them.
Correct.
Okay, that's the reason for the benefit of the TFSA. Ches, this has been fantastic. You know what? I mean, it's funny. That didn't feel like an hour to me. We could have talked on and on. Any last parting comments you want to make on? I mean, I've got the slide up here about the holistic approach. I really believe that people should have a balance of real estate, private equity, the markets. My personal belief is you should have 10 to 30% of your money outside of your principal residence in real estate. We can help you with that as the Peter Kinch Mortgage Team. 10 to 20% of your money should be looking at private equity vehicles like what we're talking about here tonight in the world of mortgages. And, a bulk of you have your RSPs in equities and bonds. I believe the best solution is a hybrid solution. Again, like I said earlier, analyze your gap, reverse engineer it, look back at what you currently invested in, and before you make any investment, whether it's AP Capital, whether you want to invest in a MIC or anything, you have to analyze how that fits into the big picture goal and know what result do you need from the investments you make. And that's what we do at TriView Capital, and that's what I'm doing in my role working with you as a broker and investment advisor. That's the book I talked about. Ches, any last parting words of advice or anything else you want to add about the MIC?
I think we've had a great hour, and I appreciate everybody's time. A lot of times I say to people, if you believe in real estate, and if if real estate is something that if you own your home, if you believe that real estate's a good investment, then an investment in a MIC, a well-managed MIC, might make sense for you. So it's something for folks to consider, and we'd love to have them, join on the run with us. So thanks again for everyone's time and for your time, Peter, this evening.
Well, thank you, Ches. You know what? Like I said, I'm biased. I used to run my own MIC. I think it's the absolute best investment vehicle out there. It's the most underutilized. One thing we didn't even get into, and I hate throwing out one last question, but real quickly, why don't financial advisors offer this product? Why is this not widely available at your bank?
Well, you kind of need to look at this. Yeah, I mean, well, you mentioned it earlier. You said, well, the exempt market, dealer, exempt market space is new. I was going to interrupt you and say, well, it's not really new. It's been around for decades, but it's always been, private companies have raised capital primarily through friends and family and through accredited investors, which is really just another word for high net worth individuals. And so, this space of investing in private companies, people like us, has always been out there. It just hasn't been available to the masses, if you will. And so when you look at the investment, the investment fund dealers that are out there, and people that, they've been selling publicly traded mutual funds, seg funds, equities, bonds, and so on. And the world has thought of investing just like I did back when I had a self-directed RSP. I guess I'll have to buy a public stock. And then my alternative as an uneducated and uninformed investor is, oh, well, I'll talk to a financial advisor, and what's he going to put me in? He's going to put me in public equities that are bundled into a mutual fund or in a seg fund or something like that. So, the investment fund dealers have always just sold the publicly traded products. I truly believe, because I'm starting to see it more and more, is that they will start to sell more and more of these private issuer products. You are already...
Yeah, whether they make a commission on it or not, because they are trying to do what's best for their client.
Yeah, no question. I mean, you're starting to see some of the biggest fund managers out there, even the largest pension funds, are buying private equity outside of the public stock market. So, anyways, we could go on and on. I love this topic.
We'll save that for our next
we'll
webinar.
Save it for another fireside.
There you go, absolutely. Hey, listen, I can't emphasize that. That's exactly everything we've just been talking about are all the reasons why I think this is an absolutely fantastic investment vehicle for your TFSA RSPs, registered funds. So if you're looking for those opportunities, let me know. Live your life on purpose. Plan your future and live it on purpose. And our next webinar, by the way, again, Ches, thanks very much. We're going to continue these interviews over the upcoming weeks as your RSP deadline fast approaches. We'll have another interview next Tuesday night where we're going to actually be talking about REITs, a real estate investment trust, with Centurion as our guest. And that wraps it up for tonight. That's my contact information. Of course, you got onto this webinar because you already have that. Folks, again, I can't emphasize enough is if you haven't already considered or you haven't made your RSP contribution, or you're wondering what to do with topping up your TFSA, give me a call, and if you have more questions on anything you heard tonight, happy to walk you through that. And as always, we're going to make sure that it fits into your the bigger picture long-term plan. Ches, thank you very much. That was enjoyable and great having you on the program tonight.
Thank you very much, Peter.
Okay, and that's the end of the recording for tonight. Thanks for joining us, folks. Bye for now.